projected 35% revenue decline in automotive, construction, and aerospace sectors by Q2 2025. Overview. As of February 10, 2025, the global economy is bracing for a projected revenue decline of approximately 35% in the automotive, construction, and aerospace sectors by Q2 2025. This downturn is primarily attributed to the implementation of tariffs by the United States, particularly those enacted during the Trump administration. These tariffs have disrupted established supply chains and increased operational costs for companies engaged in international trade, especially those in Europe and China. Impact of tariffs. The tariffs imposed by the U.S. government on imported goods have created extensive repercussions across various industries. The automotive sector is notably impacted, with European manufacturers facing significant challenges. Increased production costs have emerged due to higher tariffs on imported parts and raw materials, compelling companies to either pass these costs on to consumers through higher prices or absorb them, which strains profit margins and sales. As companies grapple with these changes, a notable decline in sales is anticipated. Analysts predict that by Q2 2025, the combined revenue from these sectors will plummet, with the automotive industry experiencing the most severe effects. The construction and aerospace sectors are also expected to face similar declines, as many companies rely heavily on global supply chains that have been disrupted by the tariff policies. Competitive strategies from the EU and China. In response to these challenges, both the European Union and China are actively developing competitive strategies to counter the adverse effects of U.S. tariffs. 1. European Union initiatives. Local production enhancement. The EU is focusing on strengthening its local production capabilities to reduce reliance on U.S. imports. This includes investing in manufacturing technologies and promoting the production of electric vehicles (EVs), which align with global sustainability trends. Investment in R&D. European companies are channeling resources into research and development to innovate and maintain competitiveness in electric and hybrid vehicle technologies. Strategic partnerships. Collaborations between companies and public institutions are being encouraged to bolster local supply chains and ensure a more resilient manufacturing ecosystem. 2. China's approach. Leveraging manufacturing scale, China is capitalizing on its vast manufacturing base to cater to both domestic and international markets. By focusing on producing high-quality goods at lower costs, Chinese firms aim to capture market share that may be vacated by companies struggling due to tariffs. Technological advancements. Investments in technological innovation are a priority for Chinese manufacturers, particularly in sectors like aerospace and automotive, where technological prowess is critical for competitiveness. Domestic market focus. The Chinese government is also promoting consumption within its domestic market to mitigate the impact of reduced exports, thereby sustaining economic growth. Economic data and use cases. The economic fallout from the tariffs has already manifested in tangible ways, including job losses and reduced investments. For instance, several automotive manufacturers in Europe reported significant declines in exports to the U.S., leading to layoffs and factory closures. The construction sector has similarly faced challenges, with project delays and increased material costs contributing to the projected revenue declines. To illustrate the severity of the situation, a recent report indicated that European automotive exports to the U.S. have dropped by nearly 20% since the implementation of tariffs, which has compounded the financial distress on companies already facing a competitive disadvantage. Analysts caution that without strategic pivots from affected companies, the projected declines could worsen, leading to further economic instability. Common themes and strategic recommendations. A consensus among industry experts underlines the urgency for companies to adapt to the evolving trade landscape. Key recommendations include: innovation in production methods. Companies must explore new production techniques that enhance efficiency and reduce costs. Diversification of supply chains. reducing dependency on single sources or regions for materials and parts can mitigate risks associated with tariffs. Building resilience, developing robust contingency plans and fostering partnerships can enhance resilience against future trade disruptions. Both European and Chinese firms are encouraged to prioritize these strategies to navigate the turbulent economic environment resulting from U.S. tariffs. Long-term perspectives. While the immediate financial impact of tariffs is significant, some analysts posit that these changes could stimulate long-term strategic shifts. For example, the tariffs might inadvertently boost local industries in Europe and China, fostering a more self-reliant manufacturing ecosystem. The emphasis on local production and technological advancement could ultimately lead to a more balanced global trade landscape. Timeline of key events. 2018 to 2020, the initial implementation of U.S. tariffs under the Trump administration begins to disrupt global trade. 2021, trade relations become increasingly strained, prompting companies to reassess their supply chains and sourcing strategies. 2023, the financial impacts of tariffs become more pronounced, with many companies reporting significant revenue declines. 2024, in response, EU and Chinese firms initiate competitive strategies focused on innovation and localized production. Q2 2025, revenue declines peak, with industries facing a projected 35% drop unless strategic adjustments are implemented effectively. Conclusion. The projected revenue decline across the automotive, construction, and aerospace sectors highlights the profound impact of U.S. trade policies on the global economy. As companies adapt to these changes, the competitive strategies developed by the EU and China will play a pivotal role in shaping the future dynamics of these industries. The focus on innovation, resilience, and local production will be crucial for navigating the challenges posed by tariffs and ensuring sustainable growth in a post-tariff world. The projected revenue decline of approximately 35% in the automotive, construction, and aerospace sectors by Q2 2025 is indeed a stark indicator of the repercussions stemming from U.S. tariff policies. However, there are several counterintuitive insights embedded within this situation that warrant further exploration. Counterintuitive insights. 1. Stimulus to local industries. While U.S. tariffs are designed to protect domestic industries, they may paradoxically stimulate local production capabilities abroad. For instance, the EU and China could bolster their manufacturing sectors as they redirect efforts to meet local demand and reduce reliance on U.S. exports. This could lead to a more robust and self-sufficient manufacturing ecosystem in these regions, contrary to the initial intent of the tariffs. 2. Increased innovation. The adverse effects of tariffs might incentivize companies in Europe and China to innovate more aggressively. Faced with the necessity of adapting to new market conditions, firms may invest in cutting-edge technologies such as electric vehicle EV production and automation, which could enhance their competitive edge globally. This innovation drive could yield long-term benefits that outweigh the short-term revenue losses projected due to tariffs. 3. Market diversification. The expectation of a 35% revenue decline may prompt companies to diversify their markets more rapidly than they would have without such pressures. This could lead to a more balanced global trade landscape where firms are less dependent on the U.S. market, potentially mitigating the risks associated with protectionist policies. 4. Supply chain resilience. Rather than solely viewing the tariff implementation as a negative disruption, companies may leverage this moment to strengthen their supply chains by investing in local suppliers and alternative sourcing strategies. Firms can enhance their resilience against future trade disruptions. This shift could ultimately lead to a more robust economic structure that is less susceptible to the whims of international trade policies. 5. Investment shifts. The projected revenue decline may lead to unexpected investment flows. For instance, investors might see the turmoil caused by U.S. tariffs as an opportunity to back innovative startups and technologies in Europe and China that are poised to thrive in a post-tariff world. This could shift capital away from traditional sectors and into emerging markets and technologies, fostering growth in unexpected areas. 6. Global competitive dynamics. The response strategies from the EU and China may inadvertently shift competitive dynamics on a global scale. As these regions invest in local capabilities and technologies, they may emerge as leaders in specific industries, countering the dominance that the US has historically held. This rebalancing could lead to a more multipolar global economy, which could be beneficial in the long run. 7. Consumer behavior changes. Despite the anticipated revenue decline, consumer behavior may shift in ways that could mitigate the impact. For example, increased awareness of local production could drive consumers in the EU and China to prefer locally made products over imported ones regardless of price. This shift in consumer sentiment could lead to sustained demand for local products, cushioning the blow of revenue declines. 8. Long-term strategic shifts. The immediate financial repercussions of tariffs might overshadow long-term strategic realignments that could ultimately benefit the affected industries. Companies may take this opportunity to rethink their business models, leading to more sustainable practices and potentially higher profitability in the future. 9. Unexpected partnerships. In response to the tariffs, companies may seek unconventional partnerships to navigate the new landscape. Collaborations between firms across sectors such as automotive and tech could emerge as a way to innovate and share resources, potentially leading to breakthroughs that enhance competitiveness and market position. 10. Evolving trade relationships. The trade tensions ignited by tariffs could lead to the establishment of new trade agreements and relationships that shift the focus of global trade. As companies in the EU and China adapt to the tariffs, they might find new allies and markets that strengthen their positions, altering the traditional trade landscape in ways that benefit them in the long run. Conclusion. The projected revenue decline in the automotive, construction, and aerospace sectors due to U.S. tariffs presents a complex scenario laden with counterintuitive possibilities. While immediate impacts are concerning, the potential for innovation, market diversification, and the development of resilient supply chains could lead to a fundamentally transformed landscape, one where industries emerge stronger and more competitive than before. The strategies adopted by companies in response to these tariffs will play a crucial role in shaping the future dynamics of global trade and industry. Important content often overlooked. 1. Long-term strategic shifts versus immediate impact. Many analyses primarily focus on the short-term financial impacts of tariffs, but the report also emphasizes potential long-term strategic shifts within the automotive, construction, and aerospace sectors. The overlooked aspect is the possibility that U.S. tariffs could inadvertently stimulate local industries in Europe and China. This self-reliance could lead to a more robust manufacturing ecosystem, enabling these regions to innovate and grow beyond the reliance on exports to the U.S. Understanding this dynamic is crucial because it highlights the potential for shifts in global supply chains and competitive advantages which could significantly alter market landscapes in the long run. 2. Investment in electric vehicle technology. While the report mentions that the EU is enhancing local production capabilities and investing in electric vehicle technology, the significance of this shift is often underestimated. The automotive industry is experiencing a fundamental transformation towards sustainability and electrification. By focusing on this area, the EU not only aims to mitigate the impacts of tariffs but also positions itself as a leader in the future automotive market. This strategic pivot could redefine competitive dynamics, making the region less vulnerable to trade disputes and more engaged in the growing global demand for electric vehicles. 3. Technological advancements in China. The report notes that China is leveraging its manufacturing base and pushing for technological advancements. Many analyses might overlook the significance of this dual approach. China's strategy to enhance both domestic consumption and export capabilities through technology can lead to a more resilient economy. The implications of this are profound. China could emerge as a dominant player in high-tech manufacturing sectors, reducing its vulnerability to external pressures including tariffs while also potentially reshaping global supply chains. 4. Job losses and factory closures. While the report mentions job losses and factory closures in the automotive industry, the broader socio-economic ramifications are often glossed over. The significant decline in revenue and the resultant layoffs do not only affect companies but also have a cascading effect on local economies' consumer confidence and overall economic health. This aspect is vital to consider as it underscores the societal costs of trade policies and the importance of strategic planning to cushion these impacts, making it a critical area for policymakers and industry leaders alike. 5. Urgency of adaptation. The emphasis on the need for companies to adapt to the changing trade environment is a theme that can be easily overlooked. The report highlights innovations in production methods, diversification of supply chains, and strategic partnerships as essential steps for resilience. Understanding the urgency of this adaptation is crucial. Companies that fail to respond swiftly may not survive the projected revenue declines. This serves as a wake-up call for industries that may be complacent, reinforcing that proactive measures are not just recommended but necessary for survival in a volatile market. 6. Global market dynamics. The report discusses the projected revenue decline but does not delve deeply into how these changes could affect global market dynamics. The shift in competitive strategies from the EU and China in response to U.S. tariffs could lead to a realignment of trade relationships and alliances. Recognizing these potential shifts is significant because they could lead to new trade agreements, partnerships, and rivalries that redefine global commerce, impacting everything from pricing to availability of goods across various markets. 7. Sector-specific responses. The report broadly covers the automotive, construction, and aerospace sectors but may overlook the unique challenges and responses within each sector. For example, the construction sector may face different supply chain issues and regulatory challenges compared to the automotive industry. Understanding these nuances is significant because tailored strategies could be more effective than one-size-fits-all solutions, thus enabling companies to navigate their specific challenges more adeptly. Conclusion. The projected 35% revenue decline across the automotive, construction, and aerospace sectors by Q2 2025 due to U.S. tariffs is a multifaceted issue that extends beyond immediate financial impacts. The potential for long-term strategic shifts, the importance of technological advancements, and the urgent need for adaptation are critical elements that deserve more attention. Additionally, the socio-economic consequences of job losses and factory closures, the implications for global market dynamics, and the need for sector-specific strategies further underscore the complexity of the situation. By recognizing and addressing these often overlooked aspects, stakeholders can better understand the implications of current trade policies and the necessary steps to foster resilience in a rapidly changing global landscape. 1. Impact of tariffs. The introduction of U.S. tariffs has created significant economic repercussions across the automotive, construction, and aerospace sectors. These tariffs have led to increased production costs and supply chain disruptions, primarily affecting companies in Europe and China that heavily rely on international trade. The anticipated 35% revenue decline by Q2 2025 reflects the cumulative effects of these tariffs, indicating a critical juncture for these industries as they grapple with higher consumer prices and potential sales reductions. 2. Competitive strategies. In response to the adverse effects of U.S. tariffs, both the EU and China are formulating competitive strategies aimed at bolstering their industries. The EU is prioritizing the enhancement of local production capabilities, particularly through investments in electric vehicle technology to reduce reliance on U.S. markets. In parallel, China is utilizing its extensive manufacturing base to support both domestic and international markets while pushing for advancements in technology to sustain its competitive edge. This strategic pivot is essential for mitigating the financial impact of tariffs and fostering resilience in the face of evolving trade policies. 3. Economic data and job losses. The economic fallout from U.S. tariffs is underscored by various analyses indicating job losses and diminished investments in the affected sectors. The automotive industry in Europe, for instance, has already reported significant declines in exports to the U.S., leading to layoffs and factory closures. Analysts predict that without strategic adjustments, the situation may deteriorate further, compounding revenue losses and exacerbating the economic challenges faced by these industries. This data highlights the urgency for companies to implement effective mitigation strategies to navigate the turbulent trade landscape. For adaptation and innovation, a prevailing theme among industry experts is the necessity for companies to adapt to the changing trade environment through innovation and resilience building. Recommended strategies include diversifying supply chains, enhancing production methods, and forming strategic partnerships. Both European and Chinese firms are urged to focus on these areas to withstand tariff-related pressures. While immediate financial impacts are evident, there is also a consideration that the tariffs could inadvertently stimulate local industries, promoting a more self-reliant manufacturing ecosystem in the long term. This dual perspective emphasizes the importance of proactive adaptation in shaping the future dynamics of the automotive, construction, and aerospace sectors. 1. The Great Depression 1929 to 1939. The Great Depression serves as a historical case where trade policies and tariffs had profound impacts on global economies. The implementation of the Smoot-Hawley Tariff Act in 1930 raised duties on numerous imports, leading to retaliatory measures from other countries. This resulted in a significant decline in international trade, exacerbating the economic downturn. The automotive industry, among others, faced severe contractions, with companies like Ford and General Motors experiencing drastic reductions in production and workforce. 2. The 1970s oil crisis. The oil crisis of the 1970s had extensive ramifications across various sectors, particularly automotive and construction. The imposition of an oil embargo by OPEC countries led to skyrocketing oil prices and a subsequent economic recession in many Western countries. U.S. automobile manufacturers struggled to adapt to the shift towards fuel-efficient cars as consumer preferences changed dramatically. The crisis prompted significant competitive strategies, including the development of smaller, more efficient vehicles and greater investment in alternative energy sources. 3. The China-US trade war 2018-present. The trade war initiated by the U.S. in 2018 under the Trump administration involved a series of tariffs imposed on Chinese goods, which led to reciprocal tariffs from China. This disruption particularly affected the technology, automotive, and agricultural sectors. Companies in the automotive industry faced increased costs and supply chain challenges. In response, firms in both countries sought to adapt by diversifying supply chains, investing in domestic production capabilities, and enhancing technological innovation to mitigate the impacts of tariffs and remain competitive. Future outlook. Predictions for the automotive, construction, and aerospace sectors post-U.S. tariffs. As we approach Q2 2025, the anticipated 35% revenue decline in the automotive, construction, and aerospace sectors due to U.S. tariff implementation necessitates a closer examination of future trends and strategies. The evolving landscape presents both challenges and opportunities for companies in these industries, particularly those operating within the European Union, EU, and China. 1. Continued revenue decline and recovery projections. The projected revenue decline is expected to peak around Q2 2025, however, the rate and trajectory of recovery will depend on various factors. Analysts predict that the automotive sector may experience a phased recovery beginning in late 2025, contingent upon the successful adaptation of businesses to new market conditions and potential shifts in U.S. trade policy. For the construction and aerospace sectors, recovery may be slower given their longer lead times for project initiation and completion. 2. Shift towards local production and supply chain resilience. In response to tariffs, both the EU and Chinese manufacturers are expected to double down on strategies that enhance local production capabilities. This shift will likely result in increased investments in domestic supply chains, reducing reliance on U.S. imports. For example, EU countries are anticipated to ramp up support for local automotive manufacturing, focusing on electric vehicles, EVs, and sustainable practices. Similarly, China's manufacturing sector may see a greater emphasis on vertical integration to bolster supply chain resilience. 3. Technological advancements and innovation. The drive for innovation will be crucial in mitigating the impact of tariffs. Companies are likely to invest heavily in research and development (R&D) to boost efficiency and reduce production costs. In the automotive sector, advancements in EV technologies, autonomous driving, and alternative energy sources will be at the forefront. The construction industry may also adopt new materials and technologies such as 3D printing and modular construction to enhance project delivery and reduce costs. Aerospace firms are expected to prioritize innovations in fuel efficiency and sustainable aviation technologies as they adapt to changing consumer demands and regulatory pressures. 4. Increased collaboration and strategic partnerships. To navigate the challenges posed by tariffs, companies in the EU and China may pursue strategic partnerships and alliances more aggressively. Collaborations between automotive manufacturers and tech firms can accelerate the development of advanced mobility solutions. In construction, firms may partner with technology startups to leverage digital tools for project management and efficiency. The aerospace industry might see joint ventures focusing on research and development to share the financial burden of innovation. 5. Evolving trade relationships and policy changes. The geopolitical landscape will play a significant role in shaping the future of these sectors. Potential changes in U.S. trade policy, especially under different administrations, could alter the tariff landscape. A shift toward more favorable trade agreements could provide a much-needed boost to affected sectors. Conversely, if protectionist measures persist or escalate, companies will need to further adapt by exploring new markets and diversifying their customer bases to mitigate risks. 6. Environmental sustainability and regulatory compliance. The emphasis on sustainability will continue to be a driving force across all three sectors. Regulatory pressures in Europe and China are pushing companies to adopt greener practices and comply with stringent environmental standards. This trend will likely accelerate investments in sustainable materials and processes, particularly in the automotive and construction sectors. Firms that prioritize sustainability may gain a competitive edge, appealing to increasingly eco-conscious consumers. 7. Labor market implications and workforce adaptation. The anticipated decline in revenue will likely have significant implications for the labor market in the automotive, construction, and aerospace sectors. Job losses are expected, particularly in companies that fail to adapt quickly to the changing landscape. However, as industries evolve, there may be a growing demand for skilled labor in areas such as technology development, data analysis, and sustainable practices. Companies that invest in workforce training and development will be better positioned to navigate these transitions. 8. Consumer behavior and market dynamics. Consumer behavior is expected to shift in response to economic pressures and changing industry dynamics. Increased prices due to tariffs may lead to a more cautious consumer spending approach, particularly in the automotive sector. As a result, manufacturers may need to focus on value propositions emphasizing quality, sustainability, and technological features to attract buyers. The construction sector may see evolving consumer preferences for more sustainable and energy-efficient buildings, prompting a shift in project designs and offerings. Conclusion: the projected revenue decline in the automotive, construction, and aerospace sectors due to U.S. tariff implementation underscores the need for strategic adaptation. As companies in the EU and China navigate these challenges, the focus will be on enhancing local production, innovating technologies, forming strategic partnerships, and prioritizing sustainability. While the immediate future may be fraught with challenges, the long-term outlook could present opportunities for growth and transformation as these industries adjust to the new economic landscape.